This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
I know, I get the emails out there. Everyone wants epic rants to start the year 2021 off. I don't have a damn epic rant right now. The world is freaking nuts. Crazy. I just saw the latest issue of Cosmopolitan magazine. 2 different women on 2 separate covers. Both of them morbidly obese. And Cosmo on the front cover is saying, it's healthy. Here we are in the middle of a global pandemic. Obesity is the number one threat, the number one way you get this damn disease. And a major women's magazine is telling women it's okay and you're healthy to be morbidly obese. I guess I just said I was not going to rant. Well, one snuck in there. I'm sorry about that. Today, let me go back in time and let me give you three episodes, 3 of my favorites, 3 really interesting people, different topic areas. First, one of the legends in the trend following space, Harold DeBoer. Took a long time to get him on. What cool insights. What a cool accent. If you're into trend following and you can't pick up something from Harold's interview, you should probably retire. Number 2, Daniel Crosby, the author. The guy with the trading psych mindset, the behavioral finance expert, or at least one of the prominent ones. He's actually been on this show, I think, twice, so you might want to go back and find his second interview as well. And last but not least, coming out of the last 4 or 5 years, where everybody wants to talk about the law in America, the law and justice, and prosecutors, and criminality, a defense attorney with 50 years of experience, Harvey Silverglate. What did he figure out? 3 felonies a day. That means if the United States government wants to charge any of us with 3 felonies a day, they can find the evidence to do it. What the F kind of system is that? That's our system. At least that's the American system. The one that we like to say is the best system that can charge any American with 3 felonies per day if the prosecutors want to trump up some charges. Without any further delay, let's jump right in and please go take a look at those Cosmo magazine covers. So damn terrible. I'm sorry, look, if you are overweight now, please lose weight. This COVID thing is killing folks that are too heavy. I tell everyone in my family, I tell my friends, go on the damn diet. Hell, I've lost almost 30 pounds in the last year. I wasn't fat, but I said, damn it, I don't want the risk. I can't seem to stop today. I keep telling you the rants aren't going to come, and here they are. Again, without any further delay, let's jump right in to Harold DeBoer, Daniel Crosby, and Harvey Silverglate. My guest today is somebody who I have been hoping to have on this podcast for a very long time. He has an interesting approach to the markets, best described as a combination of a farmer's common sense and mathematics, while at the same time never losing sight of the underlying fundamentals. You're already thinking, what kind of strategy is that? Guess what? It's trend following. My guest today is Harold DeBoer of TrendsTrend, a trend following trader with a track record back to the 1980s. A consistent track record every month back to the 1980s. He is one of the legends of the space, legends of the industry. I mean, when you have a track record that goes back that long, it starts to count for something. And now today at over $4 billion under management, TrendsTrend is absolutely one of the leaders in the trend following world. And look, one final note, as somebody who has had the chance to live outside of the States, to live in a non-English speaking country, Please give me a break today. Give Harold a break today. His mother tongue is not English, but you should listen closely because anyone with his track record and his experience, if you're not listening closely, there's something wrong with you. Without further delay, without further disclaimer, let me jump right into my conversation today with Harold DeBoer of TransTrend. One of the things that I love about you guys as a writer of books about trend following is the phrasing, the words, the descriptions that you've used for some of your world. And I love this right here. I just want to quote it. I want to read it. Our investment strategies are guided by the footprints left by people running after ideas. That is, the prices they set in the market. It's all just an idea. It has no impact if nobody buys it, nobody uses it, nobody votes for it. But every time people do run after an idea, the world changes. Our world is shaped by people running after ideas. Now, I have to be perfectly honest. I would have loved to stole that line and just pretend it's mine, but I can't because you guys already have it. But that's a great descriptor as somebody who's tried to describe this subject for a long time. Speak to me about that, the notion of the idea. How did that come about?
I wrote these lines when I was asked to explain in short what's really the idea behind what we are doing, behind trend following. And I like to do that in terms that is not too technical. And the fundamental thing behind it is there's a lot of people, economics, who believe in a kind of world turning back to equilibrium. So prices can be temporarily high, but they will come down again. The prices can be temporarily low, but they will come up again. Like there is a kind of reversal to a constant state. But if you look at the world, there has never been a constant state. It's constantly a temporary constant. Look at the big developments we have. Like in the Netherlands, until 100 years ago, people didn't drive a lot on the roads. Traveling over water was the main way of traveling. So if people invested at those moments would have said, well, now there's roads are coming and people are more and more using horses and carriages and later on cars or even trains, it will come back to the equilibrium of people mostly using boats. That, of course, was wrong. It's a normal development. And these developments, these very big developments, are happening constantly. And that is the main driver why there are trends in markets. Because things are really changing. So nowadays, last few years, you see a big move from people driving cars driven by gasoline towards electric cars. This has a big impact because that means that just simple things like in a car, which is electric, is 3 times as much copper as is in another car. And of course, this has a big impact on the market. It means that there's more need for copper than there was before, and there's more need for all kinds of other metals. And this is not something that will revert. It's a new development. It may be in 50 years' time, people are not driving electric cars anymore. We are driving from something completely different. But it's no way that it will turn back to the cars we had 20 years ago. So it's a constant development.
You know what I like about your descriptions, the way you guys describe yourselves, is that unlike some people that you might see in the quote industry, they will talk about the statistics behind something. They will get into the very academic aspects of something. Now, don't get me wrong, you guys have your academic and you have your statistical chops as well, but you guys seem to do a fantastic job of describing what you're doing in the trend following world from a very kind of hands-on approach, a very kind of way that the average guy can approach it. And again, like I said, very sophisticated, statistically based strategies, but from the ground up, philosophically, you're clearly very comfortable explaining things in everyday terms.
Yes, I have to thank my professor for that. Finalized my study mathematics in specialization in statistics. And this statistic professor was really about first knowing what the thing is about and then start to use the mathematics, the statistics, and not the other way around. He was really an old school professor that first had worked in the industry, in his case, not in the financial industry, but other industry, but he first worked in the industry, saw problems there, things that had to be solved, and then recognized what kind of statistics would fit with that. And if that statistics didn't exist already, he would make it. And based on that study, he became doctor. We say in the Netherlands, a doctor in the statistics, and then he became a professor. So first look at the real world, then choose the techniques, and then do it. Then apply the techniques. And what happens a lot is that people start with the techniques instead of start with what things going on with the world. If you look at the world, there's not many markets for which it is reasonable to assume that there is a linear relationship between those markets. Well, if you start your research, what many people do for correlation with all kinds of linear correlation measurements, you have made a mistake already. And you can keep on doing calculations, but the problem is using a linear correlation measurement like that of Pearson's, which is the most used one, already assumes that any relationship will be linear, while there's absolutely no reason to assume that it will be linear. So those fundamental choices are very important. And we often have discussion whether what we are doing is technical analysis or fundamental analysis. But it starts with fundamental analysis, meaning on a fundamental basis, decide which techniques can be used. And only then you can use the technical analysis. And then it becomes pure technical. But it starts with a fundamental basis, which is somewhat opposite to what some other people are doing. You see more traditional finance people kind of turn it around. They kind of start with the technical element and then make a fundamental story, which is just the opposite way.
You mentioned the statistics professor. Let me take you back in time. Before that, I know just a little bit about your early life. I know growing up on a dairy farm. Give me, if you're sitting around with your buddies and friends and they kind of know where you are today, but what's the connective tissue to growing up on a dairy farm? How did that shape you in terms of your world today? Because I'm sure there's some connective tissue there.
Oh, there's a lot, because a cow herd is changing also, and there's a lot of developments in the cow business too. Let's say the Netherlands used to be ahead with the milking cow. The dairy cows in the Netherlands for a long time had been kind of internationally seen as the best cows in the world, which was true until the 50s and maybe till the 60s. And then many countries were importing cows and calves from the Netherlands and crewing them, for instance, in the US. What happened is, while the Dutch were keep on thinking that their cows were the best there is, and they were only looking at all kinds of elements like how do they look like, all kinds of non-relevant issues, the cows in the US and some other countries were being bred in a way that they were producing much better, and they were growing such that they would much less diseases. They were much more efficient. And then in the 70s and 80s, the first farmers realized in the Netherlands, hey, we have made a mistake here. My father was among those farmers that started to use the sperm from US bulls again to improve the cow species again. That's something as also a development and such a thing. How do you look at genetics? And behind using genetics is a lot of statistics. So my background in statistics is really coming down and really started with looking at the genes and how that reproduces in cows.
So the real world application right there of your math background is taking place on the family farm.
Yes, I learned statistics from how it happened with cows and calves and collars and all the genes. And then later on school, learned the statistics from the statistic book, and they fit it. But that's the way I learned it.
So basically, for any of the potential competitors, the young guys or young gals that might be listening, you're basically saying, hey, hold on, you might not exactly get the education you need to compete with me at the academic universities. You might need to go to the farm.
Not only the farm, it doesn't even matter where it is. Just look in the world. I grew up a farm, and I was with it in the cows. But if you are, let's say, a railroad company and you see what happens there, you will see a lot of mathematics too. So it's everywhere. But start with looking at the world and see what's happening and see what kind of structures are there and what kind of developments are there, and realize that it's developing things. Well, we have this story also on the website that if you take a picture from 50 years ago, you will recognize it's a picture from 50 years ago. And there will never come a time that this picture can be taken again, except for in Hollywood and some other places where they can redo the history again. But apart from that, the world is continuously changing.
As you lay that scenario out, you've got the math background, you're looking at the real world, we've got the farming background, you obviously you start to know about commodities. What's the transition? When is the first time? Because we're talking in the 1980s. When's the first moment that you said to yourself, or how did it happen where, okay, I'm going to go into trading. And not only am I going to go into trading, then there's some kind of germ, a light bulb moment where you say, okay, there's this trending behavior that's really interesting to me. Lay that out for me. Lay that story out for me. How did that happen for you?
My professor said that to finish my study, it was best to find somewhere a real life problem. That was in the years that internet was not yet there and email was not there. So I had to write letters to all kinds of firms and ask them if they would have any problem in which it would be interesting for someone with a mathematics background to finish a study on. And I got two very interesting possibilities. One was with a dairy factory, and the other one was with this trading firm that traded agricultural commodities. And with my background, I was thinking, okay, later when I grow up, I will be working on a dairy factory. So I keep that one for later when I'm adult. And for now, I will have a look at this trading firm because this is something that I don't know yet anything about and it's good as an experience. So that's why I choose that one. This was a trading firm, traditional agricultural commodity traders. They were transporting them. They were crushing soybeans into soybean oil and soybean meal and so on. So it was really a traditional commodity trading firm. And what they saw is that on the futures markets they used the commodity futures markets, they saw that more and more so-called funds were active there. To their astonishment, those funds never took delivery and never did anything in the market, but still made money. And they said, well, if these people are able to make money in our markets, then we should be able to do that ourselves too, on such a more technical or more quantitative way. And that's where the project started. And I came to that project to finish my study. And it was a very interesting project. And we did all kinds of different things. My first research there was looking at the relationship between meats, so cattle and hogs or feeder cattle. In those days, you still have pork bellies, and not really anymore, but pork bellies also, in combination with the grains and the feeds, so soybean meal, corn, and so on. And there are all kinds of interesting relationship between those markets, and I studied those. And from that, we saw that there would be a way to do some kind of arbitrage type of strategy in those. But looking deeper into the strategy, we realized, okay, it can be very interesting, such a thing, to do that on a more fundamental, semi-fundamental, or semi-technical way. But there's a big risk because if you're wrong, it can be going wrong heavily. And this is, of course, a big disadvantage of all kinds of arbitrage strategies. On the same time, we were doing all kinds of other analysis. We were testing all kinds of strategies that we were being written about and that are traditional technical ways like trend lines and so on. And we were testing other strategies too. And then we found out that trend following type of strategies were very interesting. And one of the reasons they were most interesting for is that other than these arbitrage and more quantitative things, with these trend following way of things, you can trade many, many different markets at the same time. You can really have a large diversification. And where with this arbitrage thing, if you are wrong, the only thing you really can do is make your position larger because you think the markets will come together. The trend following way is just the opposite way around. It's if you are wrong, then you get out of your position, or you even revert, you go the other way. And this way of trend following also much better fitted with the idea that the world is changing again. So all kinds of relationships between markets can really fundamentally change. And arbitrage strategy is much more difficult than that. So recently in Europe, we had this issue with a trader in Norway that lost a lot of money by a spread between the German power and Norwegian power. While underlying that thing, there was an arbitrage trader, but underlying there was a fundamental change in Europe, which had to do with the price of emission rights, for instance, and with the change of climate. And such kind of fundamental change really undermines such a strategy, the arbitrage strategy. While in trend following, such a thing is no issue at all. It's a very interesting thing. The emission right trend this year is one of the best trends this year in the markets. So looking at this market and looking at these different philosophies and this different way of treating markets, we found out that trend following is really good. And the best thing about it, that it's so great to use in a diversified way. Then we had to solve one issue because the company we worked within had really chosen to only trade commodity markets. You have to realize this idea started just after 1987. 1987 was not really a good year for investing in stocks, to use an understatement. And they decided, whatever we're going to do, we never want to be in financial markets. And then we said, well, with this trend following way, you can also trade all these financial markets and even get much more diversification. So we had to explain to them why it would be wise to do the same thing in financial markets. That makes us kind of different from many traditional hedge funds, because many hedge funds, they start with financial markets and they have a background in financial markets and sometimes use that without really thinking the same strategies in commodity markets. We have really a background in commodity markets, which gives us a complete different idea about how markets are functioning, and especially when you look at the time structure and old crop and new crop, that kind of things. These things are very relevant for commodity markets. And with that background in commodity markets, we are applying it also in financial markets.
Let me keep you at that point for a moment, because I was thinking, okay, I wanted to ask you about this issue. You start off in the commodity markets. Was there ever a moment for you, given that you had to start in the commodity only markets, did you have the trend following feeling for all markets, or did you start at commodity markets and say, well, we can apply these to other markets? Or did you always know that these techniques could apply to the full global suite of markets out there?
We didn't realize that it could be done for the full markets out there at that moment, because now there are markets that were not out there at that time. So let's say stock indices were pretty new. The stock index futures had really started. 1982 was, I think, the S&P 500 was the first one. So there were not that many stock market futures. And of course, absolutely no sector indices, single stock futures. Those things did not exist at all. But currencies were being traded, bond markets were being traded. So those markets were very good to use these techniques in. Later on, we realized that you can do the same thing with sector indices and with single stock futures, but also with emission rights and those kind of new markets that all didn't exist in those years. And I think it's very relevant to keep on being active in new markets, because I remembered in 1998, I think, maybe a little bit before that, we decided that we were wanting to trade the Nasdaq futures. And our, at that moment, largest client said, why would you want to trade such a small market? And we said, well, it may be small at this moment, but maybe it grows. And I think there's absolutely no one nowadays that would call the Nasdaq future a small market. But really, that was a new market at that moment, something new. Can you really trade it? Is it going to last? Well, it is.
And hey, roll forward to modern times, because we're talking about events in the 1980s, the early 1990s. And here we are in 2018. You guys trade, 500 plus markets, yes?
Yes. But that's not relevant. Because, yes, there is 500 plus markets, but at the same time, you have to realize that the real number of different trends going on is smaller than that. So at this moment, you have an energy trend, and you can say, well, we're trading heating oil, and we trade unleaded gasoline, and we trade oil. But look, a day like yesterday, all these markets come down. And that's something you know. The real amount of markets. In the past, we were really saying the more markets, the better. And it still is true, you need diversification. But you also have to realize that the real diversification is not measured by the number of markets, but by the number of really different underlying developments, underlying trends we can be positioned in.
Let me keep you at that word for a moment, trend. There's another great line that I've seen come from your world that I think is great. Price trends are as inherent to markets as the wind is to the atmosphere. I love that one. I love the way of just getting people to think about trends and movements, because when I'm going to go into it in a minute here, I'm going to ask your opinion about factors, and the academic world is trying to find sort of things out there, but again, gets philosophically away from what you've grown up on, from what you guys have done with your firm, is to stay very grounded and say, hey, these big trends exist. They come from sound reasons. We can look at why these things start to happen, but they're unexpected. In fact, you know what? It's probably a great moment to actually jump right into the notion of factors. I find it quite interesting. What is your view of factors? The notion that the academics have said there's a factor for momentum, there's a factor for value, and you can just isolate it and find it in a back test and apply $100 billion to it.
Yes, there are factors, but those are not relevant factors, those ones. The relevant factors are, of course, if OPEC is doing something, that has an impact on oil price and on the price of stocks of all firms and of the price of the Norwegian krone and that kind of thing. OPEC is a factor. A central bank policy is a factor. People thinking about environment and want to pollute, yes, or governments that decide they have to pollute, yes, is a relevant factor. Those are factors. And those academic factors are academic, meaning not part of the real world. And I think when you talk about investing, you should explain, okay, we are buying copper now for this and this reason, and that is not because of momentum or because of value or whatever academic factor. No, you have to realize what is driving copper prices, and are we able to profit from that? And what's driving copper markets? Of course, when many investors are following those factors, then that factor does become a short-term factor. However, will generate a price movement that does not fit with the underlying markets. Because when investors are buying more and more copper for some kind of academic reason, instead of a real life reason, that doesn't mean that ultimately the consumers will use more copper, or the producers will use more copper, or that there will be less production of copper. So the idea why people are buying and selling things, if that doesn't fit with what is happening in the underlying real markets, because ultimately it's all about the real life markets and not about these futures, which should be looking at the real life markets, but not the other way around. When that doesn't work, then but those factors are not relevant. The relevant factors are what's really happening.
Does it kind of make you smile sometimes as a man who's been in the markets trading for 30 plus years, when you see some of this new branding coming around where everyone all of a sudden, and it seems like all of a sudden almost, where factor, and everyone's talking about it. Do you sometimes just sit back and smile to yourself about the branding on Wall Street?
Yeah, but branding, of course, you also have to realize that branding can become by itself a factor, which can really impact markets, especially nowadays. You really have to understand that the way markets are being driven also is to a large extent by factors that should not really drive markets, but they do so for a short moment of time. And whether you talk about a flash crash, what is really the outcome of people doing something and nothing else than that, or a somewhat longer term disturbance, prices can really go away with a serious force because of money flows, investment flows, that are not driven by what's really happening in the underlying markets. But that force can be very strong. That also means, because now often people say, well, let's say an active investment style, even a fundamental style, should be able to make more money nowadays because of the big amount of passive investors, the large amount of passive investors. But that's not true, because the power of all these passive fund flows is so large that for a fundamental investor, let's say a fundamental or active investor, you have to be able to withstand that force, because this can drive the market for a long time in a wrong direction. Ultimately, it will go in the right direction, but it makes it more harder for active investors. You have reached a point in which there's so many passive investments that are really driving markets that makes the markets more difficult to trade for the active traders, which is a problem, because it means that if the active traders cannot really have a big impact on the markets can really go away in the wrong directions for a short moment of time or for a longer moment of time, which is not really healthy for the economy as a whole.
Do you ever have moments where, as we are talking about assorted factors, and you're laying the foundation for why many fundamental factors are useful to know, useful to understand, but when it comes to your decision making is made off the simple heuristic of price action. Price action is what drives you.
Yes, we have to, because we are not a fundamental trader. So it's not that we say, okay, from a fundamental point of view, the price of cocoa is too low at this moment, so we will buy. No, we will buy if there's an uptrend. But we do realize that there can be a significant uptrend when the market has been too low for a long time, which happened, for instance, earlier this year in the cocoa market. That all has to do with, to what extent does the market as a whole still function? Market participants have an important role in that. And if more and more market participants start to behave in a way that does not really match with the underlying markets, they do have a big impact on the market. And that's something we have to take into account. So let's say a Tesla stock, you could say from a fundamental point of view, why is a Tesla stock has been rising so much while the company never made a profit for many years? Well, it's because the thing came in more and more indices, and passive investors have to buy the thing. So because passive investors are buying it, they buy more, it comes in larger indices, it becomes bigger in the index, and passive investors have to buy even more. Ultimately, it's very hard to stop such a thing. Well, this year, finally, Tesla did make a profit, I think, last quarter. But that thing is not driven by really what Tesla is doing, how well they are really doing. the most important driving factor here is getting in more and more indices, and as such, it will keep on growing, which is something you have to take into account. It means that you cannot go short a company or short any other market as long as there is so much power driving it in the other way, even if you fundamentally would say it's being driven in the wrong way. It's good to see why it works. And we very often have positions in which you would say, well, fundamentally it doesn't fit, but there's so much force driving this market on this side, we shouldn't go the other side. We are not the ones that can, the people running after ideas, that's what is happening. Let's say Brexit, for instance. We can say it's a very bad idea for the UK. Well, it doesn't matter whether we think it's a good idea or a bad idea. The thing is, it's happening, so it will impact markets. And we have to take that into account. We will have to take into account that these markets are driven by people running after that idea that they think is generally happening. If people vote for something because they believe in it, then it doesn't really matter anymore whether the thing that the ones that are, whether it's the president or whether it's a movement like Brexit, it doesn't really matter whether what they say is true. It's all about whether people are running behind it. And when people are running behind it, it will have an impact. It will create trends in markets, but it will have an impact in the world as a whole.
To follow up on your point there about Brexit, yes, you can have a personal opinion about Brexit, but that opinion is not factoring into your decision-making for the funds that you are trading.
No, but it does have a role is when things like this are happening, then we are looking at, okay, what kind of effect this can have and how do our systems work? Is there elements that will not be taken into account by our correlation measures or whatsoever? So is there any place, anything that could happen, way we work that's not right for? And it can be very simple things in are we trading the right markets and so on. We have to realize that things are happening, and we have to realize that it can create trends. And we also are evaluating whether what we have been seeing does fit with the underlying idea. So the Brexit election was a very nice case. And in many aspects, what we did was exactly what we expected that we would do and how our systems would respond to such a thing. But there were also a few surprises in there and some elements. If you said, well, okay, this happened now, but a next time with election with some strange outcome, unexpected outcome, something like that could happen again, and we could improve our way of handling with these things, for instance, in execution. So we did make some changes on the way we execute orders in very volatile environments after Brexit, and we profited from that when the outcome of the US election when Trump was chosen. Because again, then in that night, there was some erratic market moves in all kinds of markets, which we could better profit from because of changes we made after evaluating what happened after Brexit.
Let me keep you in the word trend for a moment. I want to quote from your world. I want to read this. I think it's a great small paragraph. I'm going to let you explain it even more after I read it, and we can kind of break it apart. But I want to read this. This is great. Trends in particular, those that are most profitable for trend following systems, like those in DTP, your program, are comparable in a number of ways to burning haystacks. Once such a fire is broken out, it's often hard to extinguish. The same applies to price trends. But equally important, a haystack normally does not start to burn all of a sudden. The fire is typically preceded by so-called self-heating, a fermentation process whereby the temperature gradually rises, starting at the core of the haystack, eventually leading to spontaneous combustion. Now, that is another one that I wish I wrote and I could put in my book already. I wish I could steal it from you, but I can't steal it from you because everyone knows it came from you.
Yes, that's really a thing that we worked on when we saw in 2012. In the second quarter of 2012 was a period in which normally you would expect a trend following strategy to do very well. There was a sell-off in especially emerging market equities that then went over to other markets as well. There was typical kind of movement that you would say, okay, a trend following strategy should be doing very well. And we made some money there, but we realized this is not enough. We should have been doing better in this environment. And then we tried to figure out what was happening here, what was going on. Then came this picture, okay, what was different here from previous periods? And that's this combustion thing is happening a lot. The story I think we wrote there is about the Russian situation in 1998 or 1997. The oil price had been going down for a long time for obvious reasons to be found in the oil industry. But for Russia, this was a big problem because Russia was very dependent on oil. So there was a big trend in oil. And because of the trend in oil, Russia came into problems. Until that moment, most investors in Western Europe and in the US and anywhere in the world were not really watching what is happening in Russia. It was not that people in the morning entered Wall Street and were thinking, well, let's first have a look what is happening in Russia before we start there to do any stock trading. That's not the case. No one was really looking at Russia. But then Russia came into a problem and became a crisis. And all of a sudden, this Russian crisis impacted all the market at that moment. That's when we say it's a fire and it is combusting, and then it's impacting many, many other markets, even markets in which it really should not be impacted at all. That's the thing that's going on. And these kind of movements can create big reverses in some trends. US stock market can suddenly come down too because of a Russian crisis. And as a trend follower, you normally will not profit from being short the US stock market in such a situation because it was not going on there. Where you can profit from is being at the source of the event. In this case, being short in the oil markets. That was what we were. And this oil market in that situation was at the basis of things that was happening. To make sure that you make money is you have to be sure that you're positioned at the basis where the thing is really happening. For instance, this year in the summer, the Turkish lira had been declining for a long time. And this was a typical Turkish event. It had nothing to do with things happening elsewhere. It was just a local Turkish event. And all of a sudden, one morning at 5:30 our time, I think it was the Financial Times that wrote an article about European banks that would have problems because of these Turkish things. On that moment, there was a sell-off of stock markets worldwide and also of emerging market currencies, above all in South America, for instance. That, of course, had nothing to do with what was happening in Turkey. And the thing in Turkey was going on for a long time already. But just this one thing, this one story, triggered the spreading of this fire to all kinds of other markets. At that moment, we held long positions in the South African rand and were losing on them because all of a sudden the rand was coming down because of Turkey. But to profit from such a thing means you have to be short Turkey because there it was going on already. We had very large short positions in the Turkish lira. That's at the basis, that is where the fire started, where it was going on. That awareness, that's so fundamental, that's so very important, has been the basis for many changes we've been making further on to make sure all kinds of choices you make in the programs have been made such that the chance is large, very likely, that we are sizable positions in any haystack that could become the next haystack causing the big fire. Because we have to be in that haystack and not in the ones that is being infected, because the ones that are being infected, you probably are on the wrong side.
I like how you describe a gradual start of a price increase or decrease, and you describe it as the self-heating. The self-heating is the well-informed insiders making moves. You know, when the average person sees a little bit of an up move or a little bit of a down move, they're not necessarily drawing much conclusion from that. But a price-based approach like you employ does draw a conclusion from that.
Yes, we have to make sure we do, because that's very relevant. And if we don't do, we are on the wrong leg. And when we are on the wrong leg, we are losing money. And it has become more difficult to do this. And this has to do with a broader change in the world. Let's say until 15 years ago or something, all traders didn't know everything about oil, and they were really reading everything about oil and everything was relevant for oil. People trading Canadian bonds knew everything about Canada, Canadian politics, Canadian monetary policies, and for that reason, they were really well informed in that. People trading soybeans knew everything. Let's say our former parent company, they knew everything about soybeans, and they were really not interested in monetary policy in Canada or other things. There's a lot of specialized people, and information was within that group. You still saw it in 2007, 2008. The credit crisis really started in 2007 in the interest rate markets, and it took until 2008 until it really infected the stock markets. Now, information is being spreading via internet and social networks and so on. The effect is that there's much more information available to much more people at the same time. And you would think, okay, if people have more information, they can make better decisions, but people are selecting. And what's happening is that more people are looking at the same thing. So for a short moment of time, earlier this year, many people were only looking at Turkey. It took only a week. In the next period, many people are looking at other things again and forget about the other things. So people trading oil maybe should not look too much at Turkey and should keep on focusing on the things happening in the oil market, because that can be more relevant for the oil markets. If this thing is happening and people are looking at the same things at the same time, this local self-heating will be less visible because the people that should be trading oil or that should be trading corn or trading corn are not enough looking and watching the factors that are really running the corn market, and instead are too much looking at other factors, which ultimately are not that relevant. And it means that this really relevant factor for the corn markets are not coming into the corn markets until it becomes really a problem. What happened in 2012? All of a sudden, there was a drought, but a drought doesn't start overnight. A drought is slowly growing. It is not that it stops raining and tomorrow you have a drought. It's something that is really developing. And in a well-functioning market, there are enough people, informed people about the corn market that see this drought going on. And as a consequence, the price of corn will rise. If that doesn't happen because people are too much watching the few storylines that are running all the media at that moment, then the corn market is not developing well. And it's harder to recognize the trends. And this is one of the things that makes trend following more difficult the last few years. You have to make all kinds of amendments to make it better again.
As you mentioned the difficulty from your perspective, and I'm thinking about your short-term perspective, and I'm also thinking about the notion of you don't work under a benchmark pressure, is my understanding. So let's talk about the benchmark part of it for a second, though. How has that unfolded? Now, listening to you for 45 minutes, I can see there's a very sound philosophy from the ground up. You've got a perspective, but hey, investors are often irrational. I'm assuming you've probably trained your investors very well. And of course, you've had performance for a long time. So that helps a lot. But speak to the idea of benchmarks and how you have allowed yourself, your firm, to steer clear of benchmarks, because benchmarks psychologically can really cause harm, can't they?
We, of course, as CTAs, we have much less problems with benchmarks than traditional stock investors that really are trying to stay close to a benchmark and then will trade the markets because of that. But it also had, I would say, a negative impact. Let's say in the 80s, there were some CTAs, especially some US CTAs, that were very successful, but they were not really recognized in the broader investment community. Institutional investors and so on would not invest with CTAs. Coming into the 90s and especially the early 2000s, when we had some stock market sell-offs, institutional investors realized that trend following strategies could be okay. And then what kind of happened is that trend following was started to be seen as an investment style. Instead of many different traders that do similar kind of things and all of them doing well, it became a kind of the style. Instead of people deciding to invest with John Henry or Campbell, to name some of the older names, investors decided to invest in trend following and then had to find which name to invest in. That didn't make things ultimately really better, because the essence is that there is difference between those investment managers. And it's really important that investors realize the differences, because a trend following style is not just doing the thing and do exactly the same thing. The trend following style has become successful in many years for the 80s and 90s, amongst other because all these investment managers were doing maybe similar things, but also a lot of different things. And their difference, their variation, made them strong together, which is generally true in nature. If you have, let's say, dogs too much look like each other, the species isn't very healthy anymore. Well, that also happened in the CTA industry, in which it became very important to be aware that you constantly have to make the decision which is the best decision from your point of view, instead of being some kind of pulled into an investor demand of doing exactly what people think that trend followers are supposed to do. We did not become a success because we did what we were supposed to do. We were successful because we did what we think was the best thing to do. And if I go way back in history, when we did the first studies on trend following, we found an article that says there was 3 things very important in trend following. One is you should always be in the market. Second thing is you should always trade at the same size. And the third thing was you should always use stops. And when we did our trend research, we found out that trend following was really great, but you should not always be in the market. You should not always trade the same size, and you should never use stops. So we accepted everything except for the three being recognized as the basis things. And we once were, those years, at a conference with investors. It happened in Italy, and I was there with one of my colleagues. And we were walking to the lunch, and there was some potential investors walking in front of us. They were talking to each other and said, those people behind us, they are from Transcend. They are good. Yes, the other one said, they are good. But then the other one said, yes, but they don't use stops. That's bad. Yes, that's bad. And that was good because those investors didn't decide to invest in us because we didn't use stops. We said stops is a bad thing to use. And in the last years, when, let's say, trend following kind of becomes a style in which there's a lot of stories about what trend followers are supposed to do and what they are not supposed to do. And you also see this with these independent advisors that are also then do box ticking. Are you doing this? Are you doing this? Are you doing this? It kind of drives investment managers to do things that are not really the best things to do. It's a decision to say we don't use stops. Yeah, if you being selected based on a box tick that says trend following CTA has to use stops. They don't use stops, okay, we will not invest with them. That's a bad thing. It became unhealthy. The last few years, I see some developments in making different CTAs more different choices again. And I think that's very important. CTAs have to explain what they're doing. And there should never be a list that says this is what trend followers should be doing, because there's nothing that trend followers should be doing. They should be studying the market and do the best to make money. But there's no rule like they should be using stops, or they should be using crossover strategy, or they should be using momentum, or they should be using a value at risk measure that is defined such and such way. Absolutely not.
So you guys are systematic. Have you always been systematic? Going back to late 80s?
Yeah, so the research project when we did, some of the things were based on more fundamental strategies. And we founded our research by doing fundamentally based trades. So the first trades we did in the market were really sizable trades. But nowadays, you would call them macro trades in commodity markets. So we were trading. My first research was about developing of hawks and how they responded to a drought. In 1998, there had been a drought. What impact does this have on the amount of pigs and the amount of corn? And what kind of price move then can you expect? And because of that, we decided to take a big long position in hawks and make $1 million with that. And from that, we could do our research for a long time again. That was the way we started. But we did so to finance, the right word here, yeah, to finance our research. And the research ended up into doing everything systematic. But always keep in mind the background underlying market.
I think it's a good point that I'm bringing up to buttress everything you've said, because you lay this foundation of knowing how things work to then use those real life factors to apply a trend following approach. But I think somebody listening, not knowing that you're systematic, then that throws another wrinkle into it too, that yes, you can be a very opinionated man, you can have these very strong views, but at the end of the day, your system is written down, it's coded, and you're executing in a systematic fashion.
Indeed. And this is very important nowadays in the position, because we want to make very clear, look, what we are doing is not because we read about some rules and apply them. No, what we are doing, we are watching markets, studying markets, and based on that study, we choose techniques and we systematically apply those techniques. And that's different from we start with techniques. No, we start with watching the markets, developing techniques, and apply these techniques in a systematic way.
Everything we're talking about in this conversation, all the academics, I mean, I guess there's been some change in the last handful of years, but for the longest time, you could see the academic papers, you could see the Nobel Prize winners. They were telling you for the longest time, Harold, markets are efficient and you can't be doing what you're doing. It doesn't work. It doesn't work. And here you are for 30 plus years, just kind of scratching your head. I seriously doubt you're scratching your head. You've probably been very happy with the direction you've gone, but it's got to be interesting to watch this community of folks across academia and Wall Street talking about efficient markets over the course of your career.
The academics now have turned into a complete different direction. I wouldn't even want to call them academics anymore, many of them. Look at the amount of articles that is being published now that are really nothing more than backtest results. If you did such a thing in, let's say, 20 years ago, and you wanted to publish something like that, all these articles you can read, there was a discussion about whether you had to take into account 1% price impact or 1.5% price impact. That was what the discussion was about. And the outcome always was, okay, It may seem like you can make money, but if you take the cost into account, the market impact into account, there will be no result. Nowadays, 10 years or something, it happens more and more. You see articles being published which assume no market impact. And the story there is, well, markets are efficient, and the liquidity is very large, and because the liquidity is large, you don't have to take into account any market impact. I don't see the academic thing behind that, because then I want to hear an academic story that explains me how then do markets move and how then do prices move when it is not because of and due to impact of people trading these markets. I can't find reasoning, because market impact is the only thing that moves markets. And that's the role of investors, is to be aware of that and to be aware that they have market impact and that they are the ones that are making the market. They're not the ones that can make profit out of the markets and the markets themselves will automatically go in a certain way. No, all the market participants are making the market. They make the market go in a certain direction, and all movement is market impact. So these academics that kind of say, well, look, it happens automatically and you can just do this and this and you just apply it and this will come out. That doesn't function. It doesn't function because it neglects, it denies the element that markets are being moved by what people are doing in the market. Look at a stock like Apple. People may think that the price of Apple stock rises when many people are buying their iPhones. But that's not what is happening. They can sell lots and lots of iPhones, but if no one buys the stock will not rise. The stock only rises because people are buying the stock and are willing to pay more for the stock than they were willing to pay before. And we all hope that people do so because they expect that Apple will sell a lot of iPhones. But if they forgot that element, then the price will not move at all, or the price will move in another direction than what the ultimate results of the company Apple is. So it's all about market impact. Market impact is the only thing that moves markets. And to us, as an investment community, we have to take that into account. And we have to be aware that we should never neglect the underlying market.
It's got to be comfortable is not the word, but given the longevity that you've been in the trend following space, to have a foundation, to have a real world record that people can look to. I mean, of course, the past is the past and we don't know what's going to happen in the future, but we can draw a little bit of inference from a long track record. It's got to be interesting to some degree to see so many academic folks, and I'm not saying they're bad people or anything like that, not saying they're not smart, but quite a few academics have gone straight into fund management with all of these papers and have raised a lot of assets on techniques that might not be the best thing in the future.
Oh, no. I recently gave a presentation about responsible investing in commodities. There is a lot of investment managers that are offering long-only positions in commodity futures. And some of them present all kinds of semi-academical stories behind why being long in a commodity future would give you some kind of risk premium. These stories are just completely wrong. And they can be proven wrong. If you just look what happened if you would have been long wheat from 1970 onwards and keep on rolling. It's not rolling cost that people can say, well, it's because of the rolling returns you're losing. No, it's not. From day to day, there's a risk premium normally being paid by the ones that are long and not by the ones that are short. And there's a fundamental reason for that. So all these semi-academical stories that say, well, you can invest long only in commodities and you can do like this and you will get a risk premium, and often they address to Keynes. There's one basic rule for anyone that wants to invest in commodities. If some investment manager visits you and tells you why his strategy works and he refers to Keynes, you can be sure that 1, he did not read Keynes. 2, if he did read Keynes, he did not understand it. And 3, he does absolutely not what Keynes was referring to. So such an investment manager will surely not make any money on that strategy. So the best way to recognize a bad investment manager in commodity markets is someone that refers to Keynes. The best one I once saw was an investment manager that was telling about referring to Keynes' cost of carry model. Maybe you know the model, but the idea is the cost of carry model is based on the idea that you have a commodity, you can store it and then sell it at a later moment, and the price between the futures now and the futures in the future is the cost of carry, the amount of money it costs to store that commodity. And I saw an investment manager that gave a story about it with reference to feeder cattle. Well, feeder cattle has to be alive, and I think out of my head between 3 months and 6 months in age. And I don't think there's any way you can store living cattle, calves, between 3 months and 6 months in age for a year. And in a year time, they're still between 3 months and 6 months in age. I don't think the cost of storage will be extremely high to make that happen. There are some people that would like that they could get 1 year older without getting older, but it's completely impossible. And using these kinds of theories and apply them to things that they are absolutely not connected to, it's bad academics.
Do you perceive any advantage over the course of your career where you have been based? In Rotterdam, in the Netherlands, being Dutch, has this been an advantage to you from your perspective?
Sometimes it has, sometimes it has not. Let's say for potential investors, we are farther away. And what often happens is that potential investors are, let's say they are visiting in London and they can then visit many investment managers in a few days' time. They visit 5 in a day and then make a trip and they visit 15 investment managers. And of course, they will not visit us in the Netherlands or our colleagues in Sweden or our colleagues in Paris because they are further away. The advantage of that is that the ones that do visit us are more serious. So that means the amount of time we spend with talking potential investors is smaller than others because we don't have these ones that are not really serious. There's one advantage or disadvantage, just how you want to name it. Another difference is with the staff we have. We are not competing with people that can choose for another firm that is around the corner. The people that work here, they have chosen to do this, and the alternative is to do something completely different. Most of them would not even be working in the financial sector. This is an advantage too. So the students from this region in the Netherlands, in generally, if they want to do work for a CTA or a hedge fund, they have not that much choice. That's an advantage. And another thing is, which helps is because we have different people than other CTAs, we also are better in having our own ideas. In London, you see a lot of people that have been working for one CTA and then they work for another one and then work for another one. So what often happens is that you see similar ideas with different CTAs. Because we are somewhat more isolated, we are, let's say more like the people on the islands in the Atlantic Ocean, the Stille Ocean. What do you say? The Pacific, I think it is called. The Pacific. There's the small islands and people are living there completely their own way and have colored faces and so on. Well, we are a little bit like that.
You don't want to be tainted by all kinds of bad influences.
No, it's not even that we don't want, but no, it's the being different and another place helps you to be yourself.
No, it's great insights. I appreciate you giving my audience a perspective. Perhaps we can grab a conversation in the years to come again. I really enjoy the perspective. And again, I'm very jealous at many of the perspectives that you guys have written about because I just want to steal the quotes and put them into a book, but I can't now because everyone knows who wrote them, so I can't steal them. So, but listen, great stuff. Hey, and the best place for everybody to go and check you and your firm out is transtrend.com, correct?
Yes. And look at the philosophy page because that's where it all starts from.
I mean, look, I've had a chance to speak to so many peers of yours. Probably we have mutual friends that we don't know about. And one day I'm going to have to make it to Rotterdam. We'll have to do lunch. It's been a long time since I've even been in Amsterdam. It's been over 20 years. We'll have to grab a lunch one day. I appreciate you coming on today.
Be aware, Amsterdam and Rotterdam are no friends.
They're not friends.
No.
You want nothing to do with them. You've drawn the line at Rotterdam. They're not allowed over.
In football competition, when Amsterdam plays Rotterdam, the public from Amsterdam is not even allowed to visit Rotterdam.
Speaking of that, if we get a second conversation in the future, I would love to talk to you about your speed skating story. Fascinating.
Okay.
Yeah. So listen, Harold, I appreciate you taking the time today.
Okay, thank you.
My guest today is Daniel Crosby. This is his second appearance on the show, and he brings something that I like a lot: the psychological perspective on markets, on investments. He really does the deep dive. He gets right into it. His newest work, The Behavioral Investor, examines the sociological, neurological, and psychological factors that influence our day-to-day investment decisions. And he sets forth those heuristics, those practical decision-making ideas that you can use to navigate it all. Daniel believes to have success in the markets, it's a holistic approach. It's all of these factors. There's no one magic bullet. I mean, if you're out there right now looking for the magic bullet, the silver bullet, the death cross, or whatever inane nonsense that you think will turn you into a whiz-bang investor overnight for no work, forget it. That's not where it's at. It's at exactly in the headspace where my guest goes today. Without further delay, without further me going off on a tangent, let's get into my conversation with Daniel Crosby. So in preparation of this podcast, I'm announcing this publicly. I actually went and got a foot massage, and now I'm feeling pretty good, and I'm thinking this should be part of my routine prior to any interview in the future, a foot massage. So you've started something new. Unbeknownst to you, you started this.
You've got me beat. I mean, it's 7 a.m. here, so I haven't done much.
So listen, here's where I want to start, though, a real start. I'm holding in my hands your newest book. Now, I'm going to take you, kind of weave you through a lot of interesting topics that you touch on in the book. But the first thing that I want to really ask about, I'm assuming as I hold this book in my hand, this very nice looking hardcover book, and I'm looking at this front cover, and I'm assuming this is a form of a Rorschach test of some sort, ink blots. I only see a bull. Is there anything else on this cover except a bull?
It is only designed to be a bull, but if you saw your mom or something, we could talk about that. But no, it is designed to look like a bull. You're right.
I was thinking, okay, there's going to be a trick here. There's going to be something that I'm completely missing. And now I'm talking to this guy who's all involved in the mind. So, oh no, Mike, you didn't see that.
No. You're wise to be skeptical of psychologists, though. This is a good life lesson that you should never trust a psychologist. So your mistrust was well placed.
Well, I don't know. I think if I've seen a lot of work in the psych space in the last 10, 15 years where I've had a tremendous amount of aha moments. So I tend to think that most of you folks in this space, when you're very transparent and very open and put all your views and research out there, I feel pretty good about taking that information in. And I think you do a good job of that.
Well, thank you. I'll take it.
One of the things that I really like as we kind of start to weave into this, I like the notion, and I said this to someone the other day on the podcast. I said, gosh, I wish I had written this myself because I would just steal it and just put it in my book, but I can't because you wrote it and, Google's going to know who wrote this forever. And so what I like, though, the real basic building block that you state, people are a fundamental unit of capital markets. The people are the fundamental unit of capital markets. That's a really nice way to look at things, given, and look, you're a younger guy, but you still have to go back and look at everything that's come before you. So you're well-versed and well-rehearsed and you know what's come before you. But that's a very different perspective to really put out there, isn't it?
Yeah, it is. And the example that I draw in the book was early work that was done in physics. And we had all these a long, long time ago. Folks had all of these sort of fancy ideas about what the fundamental units of matter would look like. And they would say, it's sort of a galaxy in microcosm, and it's, just sort of tiny galaxies all the way down. And the galaxy is made up of tiny atomic galaxies. I talk about how alchemists actually, for all of their work, a lot of the work they did was, of course, trying to turn basic stuff into precious metals, but they also did a lot to advance our understanding of the fundamental units of matter. And it was only once we grasped what the fundamental units of matter looked and felt and looked like that we could really begin to do important work in physics. And it's my assertion that until we own that humans are the fundamental building blocks of capital markets and work really hard to understand humans, we're just not going to get very far. And so, yeah, I think that is the place that we absolutely have to start.
For example, we can all think of a market chart. And you and I both know people will get their particular app, their particular piece of software, they'll print out charts. They want to look at charts. They put candlesticks on everything. They have all this kind of stuff. But what are those charts representative of? Those charts are representative of a price. And what's a price representative of?
Yeah, price is just the human attitudes in aggregate. It's just the consensus on that day.
Yeah, I mean, that's all it is. And I think it's kind of a fun way to have. Once you have that kind of philosophical construct, it's really just people determining whatever it is they want to believe is the price that particular day, but it's just human behavior embedded in the price.
Yeah, absolutely. Well, and I remember being a young college student. My dad's a financial advisor, and him saying, "Oh, would you ever want to go into the field?" And me saying, I don't like math. I like people. I mean, that's just, I look back at what a sort of silly misunderstanding that was and how little I knew about how markets worked. It's not math, it's people all the way down.
But on the flip side, you're very comfortable using math as a tool now to represent those people.
That's the thing that I love about being a psychologist who works in markets. If you're clinical psychologist, say, you're a shrink practicing out in the suburbs somewhere, you don't get a lot of real-time information about the attitudes, the values, the fear and greed of the people you're working with. If you are a psychologist who's fluent, who's conversant in math and knows a bit about capital markets, you've got minute by minute, tick by tick information on how the people of the world are feeling. And it's a really cool canvas against which to study human behavior.
But on the flip side, as you say that, one has to appreciate that that's what you're actually doing, because again, a lot of people could just say, oh, it's just charts, it's just data, but it's the representation of how people are feeling at that moment in time.
Absolutely.
So one of the things that I like at what you've done in this new work is just you've taken kind of, not necessarily a new spin, but you've given kind of a fresh perspective on issues that we've all known about for a long time. I like big, bold, basic principles, precepts, and something like saying, okay, we as humans, we're kind of stuck in this notion that when we reason, it's in social terms, and we kind of get out of the objective terms. Now we ignore the objective terms. We just stay in that kind of social space. That's not necessarily a good thing or it's a bad thing, but we as humans have to know that we do that.
Yeah, well, one of the most recurrent themes of the book is that things that are good for us as a species, things that have led to evolutionary success, have led us to live long lives and live happy lives and pass on our genes, have actually made us very poor investors. And this tendency to reason in social terms is perhaps foremost among them. I say in the book, if you think about what differentiates humankind from the rest of the animal kingdom, it's not communication, because dolphins can do that. It's not using tools, because crows can do that. The thing that really makes us different is that we're able to believe in these functional fictions. And my ideas here were vastly informed by the work of Yuval Harari, who wrote *Sapiens*. He basically talks about how the thing that sets us apart from the rest of the animals is that we can believe in things that aren't true in any objective sense, but that allow for us to build great civilizations. So an economy is something that's not true. Fiat currency is something that's not true in any sort of objective sense. But the fact that we all agree upon it allows us to build great civilization. The borders of the state of Georgia or the Constitution of the U.S., none of these things exist objectively in reality. But since we create them, we dream them up, and then we all sort of stack hands and agree that they're true, they allow for us to build great big civilizations and interact with people who we don't know that well. If you look at a monkey, they can only know and do business with at about 80 to 100 other monkeys, because that's all the monkeys that they can know and trust and vet. Well, we can do business with people we've never met. I could drive to Iowa right now and buy a Coca-Cola from someone I've never met, and that exchange would go very nicely because we're all playing by the same rules. That's good news for building civilization, but it also means that we reason in social terms. And I cite some research in the book that shows that if other people disagree with you about something, it can actually physically alter your perception of the world. Because we reason in social terms, we don't see the world in objective black and white truths. The opinions of other people can actually physically alter what we see with our eyes and what we think with our minds. And that doesn't make you a great investor, even though it makes you perhaps the member of a great civilization.
That little thing called evolution that kind of Darwin put us down the path, it's been great for the survival of us. It keeps us in the game, but it doesn't necessarily keep us in the market game.
That's exactly right. And, another easy example there is loss aversion. If, scientists look at why Homo sapiens persisted while Neanderthals and Denisovans and a group called the Hobbits who lived in Indonesia and all these other different groups didn't make it, one of the things that they point to is loss aversion. So we were, as a species, more fearful, more cowardly than the next guys. But because we were more loss averse, we took more calculated risks. We moved to new places if the food supply started to run short. And so our loss aversion, our tendency to be loss averse, led us to spread out. It led us to live on and pass on our genes, where our other sort of humanoid counterparts were out making dumb decisions that were brave but perhaps stupid. And so, we're here today because your great-great-great-great-grandfather was kind of a coward. And that was a good thing for the preservation of his genes, but it was a bad thing for us now trying to navigate capital markets in the 21st century.
So here you are, you're kind of outlining this anthropological history, a history of us human beings, evolution. But the key word is history. And that is something that I think when it comes to markets, when it comes to past experiences, even if they came before us, we're not very good at this market history stuff. Let me give an example and I'll let you comment. I've had multiple people write me in the last week, and I assume because of the volatility of the last 30, 40 days. But they've written me and they've said, look what's happening in this market right now. And what does that mean? I shake my head because here I am, a guy who's written a lot of stuff about longer term perspectives, being a student of history, saying, hey, when you look at a particular trading manager, you might want to examine a track record that goes back decades. And then all of a sudden, I'm assuming probably fairly bright people, but that lizard brain of theirs can't help but say, oh my gosh, I saw one particular movement in the last 30 days in one particular market, and therefore I infer this. And it strikes me like, my gosh, how are you missing this, the market history part? Where are you, the student of history?
So I think there's at least two psychological phenomena at play here. And one of them that's so damaging for investors is the tendency for us humans to project the recent past into the future indefinitely. A couple of months ago, did a study that asked investors what they were expecting from the U.S. market over the next 10 years. And the answers were somewhere in about 13.5% annualized. And so it's like people look at the last 10 years when we've gotten whatever it is, 15, 16% annualized in the U.S. and they go, oh, that's what reality is. I've gotten 15% a year for the last couple of years. So that will continue to be the reality into the future. Whereas in markets, we know that at least in the medium term, the future tends to look exactly opposite of the past. The truest words in investing are, this too shall pass. And so if we've had a good 10 years, you can expect a probably not so great next 10 years. That's a truth of markets. And the other thing I think that people do is there's a huge difference between an intellectual and a visceral understanding of something. So even if someone has an intellectual understanding of market history and they've read the right books, they're familiar with the studies, that's very, very different than sort of a gut level, visceral, lived understanding of these things. Because, I give the example of our own mortality. Like we all know we're going to die. You're going to die, but it's nothing you think about very much. It's nothing that impacts your behavior sort of moment to moment, until maybe you have a close call in a car accident or something. And in that moment, you go, oh my gosh, like I'm going to die one day. One day I'm not going to be here. And so those two things are at work. People are projecting the last 40 days of market volatility into the future indefinitely. And people, even if they have read the right books about market history, it doesn't live with them on any kind of visceral level.
But if they don't have an awareness, if they don't have a plan, and they let those particular, let's say the last 40 days, if they let that dominate their thinking, if that just becomes this kind of emotional thing to come inside the last 40 days and they kind of lose track of the bigger picture, that could be tough to get out of, can't it?
It can be tough to get out of. And it's why I'm such an advocate for rules-based trading and rules-based investing. Because basically, I mean, if you had to sum up the behavioral investor book in like a phrase, it would be something like your gut's wrong 100% of the time. The thing that feels right for you to do in the moment is nearly always the wrong thing to do. And so that's why you have to take those lessons of history. You have to take those truths and those pillars that you understand about good trading and investing behavior, and you have to automate them to the extent possible. You have to set rules and lock those things in place, because you're nearly always going to want to do the wrong thing at the wrong time if left to your own discretion.
Now, of course, you take your behavioral work to many different trading strategies. For those people in my world that really enjoy the trend following approach, what you just said is kind of the spot on psychological underpinnings of, if you're going to be a trend following trader, it's about the rules. It's not about seat of your pants. It's not about discretion, sitting there each day doing some tick by tick stuff. I mean, it's just not that.
No, it's not. You know, there's research that I cited in my last book. I looked at over 200 studies on comparing discretionary decision-making to simple rules-based, algorithmic, rules-based, systematic decision-making, and found that 94% of the time, the rules beat discretion. And I mean, you know, you have a better life. The outcome is better, but you also have less brain damage from trying to figure out these things on a moment by moment basis. You have less heartburn, less brain damage. So make more money and live a better life by being a rules-based trader for sure.
Let's stay there for a moment on brain damage and heartburn, because I think maybe people can probably read your mind and think, hey, I know what Daniel's talking about when it comes to information or whatnot that takes place in society that might give me brain damage or heartburn when it comes to the markets. What are some of the biggest violators from your perspective? I mean, how would you outline to the audience listening when it's saying, okay, you know what? If you really go down the path of listening to XYZ for 10 years, that can potentially, maybe not exactly brain damage, but maybe you are being very literal there. But what are some of the factors that you see that people really need to just cold turkey it and stop?
Well, I outlined 4 primary behavioral biases in the book. What I did is I took this universe of investor misbehavior, which is approaching 200 now, sort of 200 different biases and ways you can screw up your trading and investing. And I looked at those and I looked at the psychological phenomena that underpin them. And I said, look, there's really not 200. There's more like a handful. And there's some very consistent themes that underlie each of these 4. And so the 4 that I came up with were ego, which is overconfidence in all of its many forms, emotion, which is just what it sounds like, attention, which is our tendency to confuse salience or sort of scariness with probability. And the final one was conservatism, which is this tendency to prefer what we know, to prefer the status quo, and to prefer inaction. So there's lots of ways within each of these 4 that people get sideways. But I mean, if you think about what gives traders brain damage, I mean, just pick one. Ego is sort of the bias that emboldens all other biases, because this belief that we're better, that we're different, that we're luckier, all of which are facets of overconfidence, this all sort of emboldens bad investing behavior. And I think the fundamental realization that someone can have about themselves, an investor most of all, is that they're flawed and that they're mediocre and that they are prone to all the same stupidity as the next person. And it's only when you have that realization, every other thing you will learn about your life is an adjunct to that first realization that you're not that great. So it takes that realization to have any subsequent realization about what you should be doing differently.
It really is a grounding type thing that if you can allow yourself a lot of freedom, a lot of power, if you can say to yourself, my gosh, I'm just average like everyone else. But then once you admit that you're average and you say, okay, I've got all the same biases and, problems that every human has. But then once you can acknowledge that, there's a tremendous amount of power, because then once you can acknowledge it, then you can get right back to the rules mindset and say, how can I create some heuristics? How can I create some workarounds, some hacks to keep myself going on the straight and narrow?
Yeah, the market is full of paradoxes, and I think this one is the keystone paradox, which is only by realizing how not great you are can you become truly great. Because I believe that you can do great things. I believe that you can have an extraordinary life and generate spectacular returns. But all of those things are strangely predicated on admission of your mediocrity. So it's just one more paradox to add to the bucket of them that markets give us.
Let's stay there for a moment with your background as a psychologist. I mean, we're almost not even really dealing with an issue of markets, but for people to admit this, for people to admit that, hey, I'm just average and I'm not really Superman who's just one lucky lottery ticket away from everyone in the world knowing that I'm Superman. How do you start to get people over that hump? Do people have to want it a little bit? They have to want to get past something, because if people are unwilling to even acknowledge this, it's going to be really hard to get them to see your point of view, isn't it?
It is tough. And I think there's a couple of ways that we can do this. So I think the first thing to do is just look at the data. I cite studies in the book that basically say that the correlation between self-reported investment performance and actual investment performance is indistinguishable from zero. So most people, as a function of this overconfidence, aren't super up to speed on their trading record. And when they're not up to speed on their trading record, they just assume that it's good. And so take over a long period of time, take and compare, look at the relevant stats that show how you have done, because the research shows that among people who think that they've beaten the market, 1/3 of them have underperformed by 5% or more, and another 25% have underperformed by 15% or more. First thing to do is just look at the data. The second thing to do is something that you and I do, and I think hopefully that gives us a bit of humility, is that you have to teach. Because Richard Feynman, the famous physicist and great thinker, had this great technique for figuring out what you don't know. It's basically teach it to a kid. And so this is why I write books. I write books. I've written a book about every 2 years. And the reason that I do this candidly is not because it makes any money. It's the reason that I do it is to figure out what I believe and to hone my own thinking. So if you think you're sharp at something, I would encourage you to try and write a book about it, write a blog post about it, teach others about it. And if you can't teach others about the basics of a topic, you just don't know it that well. And then the third thing that I encourage folks to do is to just look at base rates. I had a financial advisor come to me recently who wanted, not a financial advisor yet, was getting licensed and wanted to start their own firm, start their own RIA. And they thought that they could get to $100 million in assets under management in under 6 months. And I said, hey, that seems really aggressive to me. That seems very optimistic to me. Why don't you look at the base rates? Why don't you look at how long it takes most people to get to $100 million? And the answer was closer to 8 years. So that's a sort of a third way, is to plan your life relative to averages. To say, look, if it takes most people 3 years to write a book, it's probably going to take me 3 years. Most people do this. It's probably going to be what happens to me too. And then be surprised to the upside if you outperform. So those three things: look at the data, just be dispassionate about that. Look at the data, become a teacher, look for ways to teach other people. That's going to help identify gaps in your own knowledge and learning. And then finally, to look at the averages. We would, as a culture, be so much better off if most people would just own that you have a 50-50 shot of getting divorced. If you, on your wedding day, you ask people on their wedding day, hey, do you think this is going to work out? And 100% of people will say yes. And yet, we as a culture have a 50% divorce rate. And I think if we were a little more honest about that from the outset, We'd work a little harder. We might go to premarital counseling. We might do the work we needed to do. So it's only when you own those averages and those probabilities that you can do the hard work that you need to do.
You know, it's really tough about that divorce rate stat that you just tossed out there. My grandparents got to like 50 or 51 years of marriage. My parents have surpassed 50 years in marriage. So when you got these family touchstones that go on forever, it's really difficult to have that conversation. But you're right. I mean, I think about that all the time. I think, my gosh, when it comes to relationships and the modern age, you've got to look at the base rates. You've got to say, what is average? What is the probability? That doesn't mean you go into something, looking for the worst, but you also should not be having the rose-tinted glasses on, imagining that, it's all pie in the sky.
You make a great point there, because I want to be clear here, because if you look at the base rates alone, no one would ever start a small business. No one would ever open a restaurant, because probabilistically speaking, these are both low percentage shots. These are not great ideas. And I'm glad people start restaurants, and I'm glad people start small businesses. But just use these base rates to sort of chasten your thinking a bit, not saying, 50% of the world gets divorced, so like you're doomed to a life of being on your own. That's not the takeaway. I think the takeaway is, 50% of people get divorced. So work hard at it. Take a class on communication, go to counseling, look at your own quirks before you try and bring someone else into your life. And the same can be applied to investing. More than half of individual equities have catastrophic losses over their lifetime. The life of an average stock is nasty, brutish, and short. And so if you think you know something, if you think you want to take a large position, or you think you want to invest in something, be damn sure that you've done your homework and know the probabilities are not on your side. And so make sure you have an edge, make sure you've done your homework, and don't never take the shot. Just make sure it's an informed shot.
Yeah, it's a great point. There's a great piece out there by the late, great Stephen Jay Gould out of Harvard. And I believe he got an early cancer diagnosis. And basically the doctors did one of those typical things like, you got XYZ amount of time and then you're gone. And that happens to, 60% of people or whatever. But then he went ahead and he looked into it further to say, well, what does the data really represent? Which is, I think, is where you're trying to go, which is like, if 50% of marriages end in divorce, well, is there something we can look further at those particular marriages? And of course, this kind of thinking could apply to investments as well, is to dig in a little bit further and find out, perhaps did those winners do something a lot different than the people that bailed or the people that did not succeed? So it becomes a challenge. There's never kind of some surefire way. You really got to do the work.
You really do. You really do. And, another thing that I talk about in the book is one of the surest ways to have a disappointing life and a disappointing trading life is to believe that you can perfectly manage risk. So you really do have to walk this tightrope and say, look, there's some risk inherent in any good thing you would ever do. And if you try and live a life wrapped in bubble wrap, you're going to be broke and sad. So take risks, but take appropriate risks. And I think that managing overconfidence is one of the primary means by which you can help walk that line.
So as you bring up the idea of living in bubble wrap, we were kind of talking about big populations under the bell curve in the middle. I think most Americans that have their typical retirement account are slammed into a passive index fund. Kids are going to do the standard issue 4-year degree, get out and try and get the standard issue job if it still exists. There is a lot of bubble wrap thinking. I mean, it really does require you to kind of get outside the box to get into the mindset of the behavioral investor.
It does. And one of the things that's true of life and markets is many people are content to work their mediocre jobs with their mediocre degrees and come home and have a hungry man dinner and fall asleep watching their favorite shows, right? I mean, I think for most people under the bell curve, that's always going to be the case. But you got to remember too, that therein lies the potential for success, the potential for arbitrage for the behavioral investor, for the person who's willing to stay up a few hours later, to do a little extra work, to do a little extra homework, to endure a little extra discomfort, because I think if there's no pain, there's no premium. So I think a lot of times the pain is psychic. So I think for people who are willing to put in the work and endure that pain, I think therein lies the opportunity for a rich life and a richly rewarding trading life as well.
Hey, by the way, there is no particular, and I've seen you write about this, there is no particular personality type that if one wants to go down this path of thinking in rules and kind of pushing discretion out of the toolbox, there's no personality type, is there? I mean, it can be anybody.
There's not. So I was interested in this. People have asked me why write another book relatively hot on the heels of my last book, The Laws of Wealth. And one of the reasons why I wrote this book is I go to so many conferences. I'm a frequent conference speaker, and I was just hearing so much bad information set forth by trading gurus and behavioral coach types that are loosely regulated and experts in their own mind. And
give me some examples there. I want to hear some of the latest trading guru nonsense that's being pushed.
There were a couple of things. And one of the big ones was this idea of personality. That's like, I've got a personality test and we're going to tell you if you've got the right chops to be a trader and you're a good investor, and here's the personality traits that you need. And I dug into the research, and it's nonsense. I mean, there's people of all types, people of all stripes and walks of life can be great investors. It's more about following rules than coming out with some specific personality type, which is good news because science is telling us now that about 50% of your personality is set genetically, and about 10% of the decisions you make are down to situational variables, and about 40% up to the choices you make. Effectively, what these folks are saying is you're born with it or not, and I would take strong exception to that. What I found in researching the behavioral investors, that personality types of all kinds are potentially well positioned to be good investors. It's really more about following a set of rules than being a specific type of person. The other thing that I found very consistently was sort of misinformation around emotion. There's a couple of chapters in my book about emotion, and it's very nuanced, but these folks were kind of saying, look, tap into emotion as sort of the sixth sense of where you should be doing. Long story short, the data does not support the fact that strong emotion is a good tell or is a good trading signal. In fact, it's usually very bad.
As we're talking about personality and the idea that anyone can go down the right path towards being a good investor, I'm thinking to myself, the conversation comes up, you're at a particular conference, the conversation comes up, somebody, a guru, etc., is saying, you really need this particular type of personality. Now, there's an audience out there. The audience is, let's say, 500 people. So there's a guru on the stage. He says, you 500 people out there need a certain personality. What I immediately think about is how many people in the audience think, my gosh, that's absolutely bullshit, versus how many people think, oh my gosh, he's going to tell me if I'm in the club or not.
Yeah. So one truth about life, I think, is that people want easy answers to hard problems. And so saying, I've got a personality test in a course that'll tell you if you're on the right path and put you on the right path is an easy answer to a complex thing. And so I imagine there's many, many people who want to pick up what this guru is putting down. But there are certainly people who also are informed consumers and understand that in a lot of cases, this is a sales thing. People have a hammer, so they see nails everywhere, this sort of thing. I think you're always, again, going back to our person that's eating their TV dinner and watching their shows. I mean, there's always going to be people who think, oh, good, here's a silver bullet, and this guy's figured out what it takes. But I think the ability of some subset of the population to think more critically, take the road less traveled, is where our potential for outperformance lies.
You know, as you give this very nice, studious presentation, speaking with me tonight, this morning in your case, I'm looking at a particular quote that you cite in your work from Pliny the Elder. The best plan is to profit by the folly of others. That is hardcore for some people. The best plan is to profit by the folly of others. I assumed when I saw it in your book, you meant it for what it is. But of course, one can take that emotionally. They could take that in a negative connotation, or they could take it like you just said a minute ago, which is like, hey, if you want to be average, you can be average. But if you want to spend a few extra hours a night, you can find out how the game really works. And the game does really work by funneling and channeling money from people that are making bad decisions with bad plans to people that have good plans and make good decisions.
Yeah, that's right. And I don't want that to sound overly aggressive or antagonistic. It's just sort of a fact of life. There's always going to be a large percentage of the world who's trying to get rich quick or take shortcuts or not do research or not do anything. And yeah, again, those people who are willing to endure the pain to get the premium and the people who are willing to do the work, it's not like they're tricking other people or they're being mean to other people. They can just sit back and patiently know that as they are systematic and cool, calm, and collected, they can know that other people won't be taking that path. Like, I'm bullish human irrationality from here to forever. If we follow that path, we will profit from the folly of others.
Now, look, there's a lot of things that I've said in this conversation, things that you've said, things in your book, which can cause people that are really invested in that ego, really invested in their emotion, they can react very violently to being challenged. I mean, they can be challenged by you giving a presentation, giving a podcast interview. They can be challenged by your work. But just from a big conceptual perspective, people often don't like to be challenged. If they're set in their ways, they really don't want to hear it. I mean, I had a guy who was just emailing me with me before our conversation, and I was kind of trying to give him a basic explanation of what a price breakout was. And he kept coming back to me with all these candlestick charts and all this candlestick nonsense. And I just said, what are we talking about? I don't even talk about this stuff. Where did it even come from? And I literally had to kind of say, stop that. And I could feel that he didn't like being challenged. Here he is coming to me saying, how do you do what you do? And I'm trying to tell him, but he's basically trying to use all of his examples from whatever his world is. And I'm telling him to stop. And he doesn't like that.
Probably my favorite psychological bias is something called Dunning-Kruger effect. Dunning and Kruger were these researchers who their stream of research was prompted by one of the most amazing things I've ever heard of, which is someone tried to rob a bank covered in lemon juice. So this bank robber covered his face in lemon juice and goes in to rob a bank and, of course, gets caught very quickly. And the guy is sort of flabbergasted when he gets caught. And he goes, oh, my gosh, how could you see me? I thought I was invisible. And they go, what? And he said, well, yeah, when I was a kid, I would do invisible ink with lemon juice. You know, I'd write on paper with lemon juice, and it was invisible ink. So I thought that the lemon juice would make me invisible, too, and I'd be able to rob this bank. And so Dunning and Kruger are like, whoa, what is going on here? And they do research on how effectively dumb people are too dumb to know how dumb they are. And the same thing can be said of arrogance or overconfidence. Like if you've read my book or you've listened to this podcast and you're thinking, you know, what an idiot. This guy doesn't know what he's talking about. This isn't me. This is so not me. I'm not susceptible to any of this. The fact that you think you're not susceptible to any of this overconfident stuff, any of this bad behavior, is the surest indicator we have that you are susceptible to it. And again, paradoxically, if you've been listening to this and going, wow, you know, I really have some improvement to make, I could do a lot better, you're actually probably okay. So it's a weird thing that the most overconfident people in the world aren't well positioned to realize their own overconfidence, except if they realize those feelings of defensiveness. So that's just a good gut check, I think, is to say, look, if you feel enraged by what someone's trying to teach you when you're working with this guy, if you feel defensive or angry or whatever, that might be a good prompt to say, hey, maybe check your ego at the door.
Yeah, it's very difficult for people, really. I mean, it's extremely difficult to watch people in the throes of it. And you want to be very frank with them and be very open. But sometimes you just got to let the chips fall where they may. I mean, tell people, here's the perspective, here's how I can help you, here's what's really going on. But, you know, some people, they might not make it there. Flying out of that for a moment, because I could take you to so many different pieces in your work. There's a line that I caught here, and I don't think I've ever written anything like this myself. I love it. It's very simple. I think, though, the only problem is when you write a bunch of stuff, and I'm sure you face this too, you sometimes forget everything you write. You can't remember. You almost have to search it. But I love this line here. Data without theory and theory without data produce spurious results. I mean, data without theory, these are the guys that sit on a backtesting engine and find something that has no real grounding in real life and think they've got something. And then there's the folks that have this fanciful theory about, freaking the golden mean and the pyramid is got this particular triangle and therefore it means this. And but that's a great line. Data without theory and theory without data produce spurious results. Fantastic.
I appreciate it. So yeah, you're exactly right. So you need, I think, three things. I think you need theory, I think you need data, and I think you need psychology. The reason you need theory is just the reason that you said. The Fed produces 45,000 different pieces of economic data that they report on. So if you put all of these data points in a blender and regress them against the S&P 500 over the last 100 years, you're going to find some correlations, and a lot of them are going to be meaningless. There's all the funny ones. There's, like a 95% correlation between moves in the S&P and Bangladeshi butter production. And, there's the Super Bowl indicator that's actually still pretty good. I can't remember if the AFC wins, then something. But anyway, yeah.
But to use that information is gambling.
Oh, yeah, absolutely. So this is data without theory, and you can just get silly results, spurious results that have no basis in fact. Now, the flip side is also problematic. You've got some great macro narrative. You've got some theory about the golden mean or whatever sort of fanciful idea you have, but that needs to be backed up by the data. If there's really something there, your theory needs to be sound, and then you've also got to have the data to prove it out. But the third piece, that I want to talk about is I think it needs to be rooted in behavior, because market anomalies that we discover that have no pain, that have no behavior associated with them, I think they quickly get arbitraged away. Calendar effects and all these little quirks in markets that we can discover and go, oh, gee whiz, that's easy. And that gets quickly arbitraged away. I think the only enduring edge is this confluence of these three things. It needs to be grounded in a sensible theory. There needs to be data to back it up. And there also needs to be some sort of behavioral reason why it exists, because behaviors persist. Even bad behaviors, even irrational behaviors persist. Even if people know about it, can be hard to arbitrage it away because of bad behavior. So I would bet money, if there were a way to do it, I would bet money on American obesity for the next 50 years. Because even as...
Getting worse, you mean?
Getting worse, yeah. Because even as we become more informed, even as we have more healthy food available to us, even as we become more informed about nutrition, it's just still hard to eat the right thing. It's still hard to exercise. I'd bet on that bad behavior going forward, even as new information comes online. And similarly, I would bet on things like value and momentum long into the future, because they have behavioral underpinnings to them.
You're laying out a case on this podcast in your books, what I would call as a contrarian perspective. I'm curious to hear your definition of contrarian, but I would say it's a contrarian perspective. Now, a contrarian perspective kind of sounds good to all of us rebels, all of us kind of entrepreneurial perspectives. Oh my gosh, I'm a contrarian. Now, the flip side here, though, is the contrarian perspective doesn't mean you are going to be without pain. It doesn't mean that it won't hurt. And I think that's another element to this too, is that once somebody goes down the path that Daniel Crosby is outlining, the kind of put aside the discretion, get your system, automate, that doesn't mean that you're going to make 5% a month every month for year after year after year.
No, it doesn't. And in fact, basically any reputable system you could dream up is going to have periods of underperformance. I mean, if you've back tested something and it never underperforms, then you've got spurious results. Once again, you've got a Madoff machine, not a real strategy. I cite research in The Behavioral Investor that compares value investing effectively, or contrarian investing, value investors in particular in this study, but it compares the emotional response to being a value investor to stuff like being picked last at kickball, to things like social isolation. So being a true contrarian, which is exceedingly rare, everyone thinks they're a contrarian, not many people truly are, but being a real contrarian hurts like hell. It's socially isolating. You're going to think you're crazy. You're going to think you made the wrong choice. If you're not experiencing those things from time to time, you're just not a true contrarian. I cite research in the book. I talk about this funny book about sort of rebels and punks through the ages, and how something like a gutter punk or a prep or something would have more of a uniform than your average businessman. People who have mohawks and leather jackets, they think they're going their own way, but they adhere to tighter social protocols than your average stockbroker in terms of what to say and what to listen to and what to wear. Contrarianism is one of those things that everyone thinks they are and not many people are. And the true way to determine if you are is how much it hurts.
I was thinking about the curious case of social media. I will not throw a name out there or any kind of reference to a particular individual, but I see quite a bit these days where people are involved in social media and they put their public face out there, and they are perhaps associated with people that have radically different views. But because of these kind of social constructs where they don't want to really upset the apple cart, they kind of just stay associated with it all. And even though it might be bad information that's coming into their noggin every day, they still do it. Then on the flip side, they might go outside of the social network and then complain with other people that have the same kind of view. I'm seeing this quite a bit where I think that social pull, which is a lot of what you write about, that social pull to fit in, that even if it's against your very basic nature that you know is wrong, this desire to fit in and be a part of the team and don't feel isolated. Boy, that's really tough to overcome.
It is tough. And yet I've found personally, this is just anecdotal experience. I quit Facebook a few years back, nearly 3 years ago now. And when I did, it was like an immediate 10% boost in productivity and happiness. You know, you think you need these things. You think that you're using these tools to become socially connected, but all of the research points to social disconnection and very sort of fleeting, superficial connections that happen over social media. Now, I think social media can be used to be a catalyst for in real life connection that can be very, very powerful. But if all you're doing is talking with people or arguing politics with people on social media, I think the damage can be considerable and the upside is limited. Put me in the camp that thinks of Facebook as sort of the new Philip Morris in terms of its contribution to society.
I think that's a great place to end it. Facebook is the new Philip Morris. So Zuckerberg is right now will be getting ready to scan this podcast, reduce it to text, and send an army of bots out to ruin our lives. I'm about
to say, when I die after this podcast is released, go look for Mark Zuckerberg. Yeah.
Yeah, exactly. Okay, the book, The Behavioral Investor, out now and about. Find it anywhere and everywhere. Daniel, where is the best website that people can go to find out more about you?
The best place to find out more about me is Twitter at Daniel Crosby. I have my own podcast, the Standard Deviations Podcast, or look me up on LinkedIn and connect with me there.
Cool. When did you start the podcast? How long have you been doing it?
I've been doing it for 50 episodes, so about a year now.
It's addicting. You'll never stop, right?
I love it.
It's literally, it will be impossible for you to stop. You start to get 50 plus. It's going to be like, I mean, because you get a chance to like talk to interesting, wise people and have cool conversations. And again, it kind of keeps you out of Facebook, keeps you off Zuckerberg's hit list.
That's exactly right. It's a professional reason to have conversations with people I admire, not a bad gig.
Daniel, I appreciate you coming on again. Please let me know when the next book is out.
I'll see you in 2 years.
My guest today is Harvey Silverglade. He's an attorney, specifically a defense attorney, and specifically with 51 years of practice. Today we discuss, amongst many topics, 3 felonies a day, how the feds target the innocent. His book about how all of us in America, if the prosecutor wants to come after us, can probably nail us for 3 felonies every day. Yeah, let that one sink in for a second. Harvey brings a very blunt, very direct view on the law, which I welcome. His perspective is a perspective we can all learn from his close association and shared perspective on many, many levels with Alan Dershowitz, the famed Harvard law attorney, to his personal experience with the independent counsel, Robert Mueller. Harvey has been around the block. He has seen a lot. For those of you that are mystery fans, you might recognize the name Jeffrey McDonald. Harvey was defense counsel for Jeffrey McDonald. So fortunate to do this podcast. So fortunate to bring on people with just amazing experience and honestly, the right perspective. I hope you enjoyed this conversation with Harvey Silverglade. I'm really excited to talk to you today. There's so much in the current American debate, and you're one of those guys that I think has a bright light that we can all look to that hopefully gets everybody past their tribal debates and gets us looking at perhaps the third pole, which is just the way the law should be. And I think you've got some great insights there.
I hope so. Well, maybe I don't hope so. Not necessarily good news if I'm right.
Let me throw a big one at you because, you know, it's been all the rage and all the debate in America for, almost a year and a half. I think it's a great place to start and let you kind of, from your perspective, when you're kind of just thinking to yourself as a lawyer for many decades and lots of experience, and as you watch a political situation unfold that has legal ramifications right now with the President of the United States. Now, the typical debate on this is very political, right? You've got the left view, you've got the right view, and everyone's very tribal about where they see things. I have a sneaky suspicion, though, that when you're alone or when you're chatting with an associate of yours, perhaps like Mr. Dershowitz, you guys look at this much differently. You're looking at the law and how that's unfolding. Can you give me your perspective right now? Even pick one particular area. It's pretty broad right now. When you look at what's going on with the current situation with the president, do you have any views on this right now?
I think that the whole country seems to be in some kind of psychotic episode with respect to analysis of whether or not the president and his various minions have committed felonies. People in news media that traditionally have been somewhat sympathetic to my point of view, expressed most prominently in my book, 3 Felonies a Day, How the Feds Target the Innocent. They've been very sympathetic to my point of view that a lot of innocent Americans have been harassed, prosecuted, even tried, convicted, and imprisoned by the Department of Justice, even though they have not committed what any normal human being would consider a crime, and which was not obviously criminalized by the Federal Criminal Code. They've been sympathetic to my notion of over-criminalization, over-prosecution, over-incarceration. And now that these very people who have sort of been on my side, and Dershowitz and I agree on this completely. He wrote the foreword to my book, 3 Felonies a Day. We agree on these things. We have for a long, long time. Now, the media and people on the left, so-called progressives, have turned against Trump, and they now suddenly see crime everywhere. And it just shows you how few people really assess things objectively and according to principles. And instead, they analyze the law by first asking the question, is this somebody I want to get, or is this somebody I want to be on their side? And that is a hell of a way to run a legal system. And that's what's going on. I am not a Trump fan, I tell you. I did not vote for him. I didn't vote for Hillary Clinton either. I thought that neither of them deserved to be in the White House. I voted Libertarian in the past election. politically, I have no horse in that race. I do think that if the people who are the hound pack that is pursuing Trump is allowed to have its way, and if they can actually indict and convict, and Mueller can indict and convict a lot of the president's men and women, that the law will suffer. There will be a huge setback in the effort to modify the federal criminal code into a set of laws that normal people understand and that's clear and that targets real criminal conduct rather than simply conduct that people don't like.
Well, let's face it, going down the path of your work, your book, every last person that has been targeted in this probe they should be able to get multiple felonies on them, because not only could they get multiple felonies on the president and whoever he's associated with, they could get it on yours truly, me, and yours truly, you. They can get it on anybody. That's your whole point.
Yeah, well, what they've done, you see, Mueller has done a couple of things, right out of the federal prosecutor's bag of tricks. First of all, a lot of the prosecutions that he has either threatened or actually brought are for making false statements to federal investigators, FBI agents. And as I've written in my book, the false statement statute is a gigantic trap for the unwary. Because what happens is an agent comes up to you and does an interview and then writes it up in a so-called Form 302. And number one, the agent almost never records the interview. The version of the interview that is represented in the 302 report written up afterward by the agent is sort of the official version. And you can argue all you want that that's not what you said, but it's your word against two FBI agents. And those prosecutions are more often than not completely phony because they're based upon a false version of what actually occurred in the interview. That's number one. Number two, even when the person interviewed actually lies to the agent, most people don't realize that that's a federal felony. Why don't they realize it? Because they're not sworn. Normal people think that it's all right to tell a lie to a cop or an investigator as long as you're not under oath. If you're under oath, that's a different story. Then you're legally obliged to tell the truth. The federal false statement statute is a real trap because you can be charged with a 5-year felony for any misstatement made to any federal official. And I have news for you. That would include your local postmaster. You're talking about millions of people who work for the federal government. And a lie to any one of them can expose you to 5 years. And that's a lie that's not under oath. So it's a real trap for the unwary. And Mueller is an expert at exploiting this, what I call bizarre criminal code. It's not, a lot of people don't consider it bizarre because we're so used to it. Oh, so-and-so is charged with lying to an FBI agent. What's wrong with lying to an FBI agent? You're not under oath. And yet, that is the way Mueller is conducting this investigation. What that tells us is he hasn't really found any real crimes, so they're making up crimes. They're getting people into the position where they're vulnerable. Now, what's the next step? Once you have been charged by Mueller with a 5-year felony of lying to an FBI agent, you are then vulnerable. And then Mueller and his people go in for the kill. Oh, they say, yes, we will prosecute you unless you cooperate with us and tell us what you know about Trump and his various minions. And if you can tell us the crimes they've committed, we will let you go. We will either give you probation or we'll even dismiss this false statement charge. And then you have the phenomenon of what my friend Alan Dershowitz calls, they get the witness not only to sing, but also to compose. What does Dershowitz mean by that? It means that the witness at that point, facing 5 years for lying to an FBI agent, will now say whatever Mueller wants them to say, because they figure that's what Mueller thinks the truth is. And that's where the composing takes place. And that's how come so much lying and so much perjury, so much false testimony is woven into the criminal justice system by that simple set of steps that I just outlined for you. This is not a criminal justice system. This is a prosecutorial system, and it's in dire need of change. But I don't see anybody on Capitol Hill or anybody in the White House looking to actually change it.
Well, when you have all that variability and the law is subjective, it gives whoever administers it immense power. Why would they want to give that up?
Exactly. Even the party out of power figures someday they're going to get back in power and they'll be able to get even with everybody by using the FBI, Department of Justice, the federal courts, in order to bring 3 felonies a day type prosecutions against their enemies. You've got this lethal weapon out there that is completely unfair and has nothing to do with the truth. It is just out there to increase the power of whoever happens to be in authority. And I should also tell you that it also gives the FBI institutionally tremendous power, because the FBI has a certain amount of power that doesn't even depend on who's in the White House or who controls Congress, because the FBI as an institution has its own power. It's been like that since J. Edgar Hoover was the director, and it hasn't changed since the death of Hoover.
I want to throw a couple examples at you from my own experience outside of something like Trump. Because look, Trump is so divisive right now. Some people won't listen at all if they hear the name Trump. Some people will go, yeah, that's great. Years ago, I had a land use case that made it to state Supreme Court. 2 things happened in that case that I recall that were really interesting. One that you just mentioned. Well, there was a situation where we needed to look at the minutes of official meetings, right? But the minutes had been edited from the original recordings, right? Even though we had the original recordings at our disposal, which bolstered my position, the court said no, because these are the official adopted minutes, which had been edited and didn't bolster my position. So it was the craziest thing. You just made that point. So even though the FBI is not recording, in my situation, we actually had the recording of the local government, but we couldn't use it because they adopted something that was completely different than what the actual meeting minutes took place. And we had the recording of it. Completely crazy.
You're talking about an example of a state court system that shares some of the problems and liabilities of the federal system. Generally speaking, you have these ridiculous situations more in federal investigations and prosecutions than state. But the states are not immune from this. And you're giving an example here of a judge who kind of formulaically, blindly followed what's considered normal procedure, even though in that particular instance, the facts argued to the contrary. It's, the old joke, but it's not really a joke. Don't try to convince me with facts. My mind is made up. I've actually heard that from judges. It's crazy. Reality doesn't matter when bureaucratic efficiency is running the show. It's mind-boggling. I really say I have now been a criminal defense lawyer for 51 years. I've practiced in state courts and federal courts all over the country. And I have to say that if I was writing my memoir, which 3 felonies is not, it's sort of limited 3 felonies. I've talked about a few of my own cases, but not very much about my full experience. I would say that I have been practicing law in the land of Oz.
What do you mean exactly when you say that?
I mean that it's something otherworldly about it. It's a combination of Wizard of Oz and Alice in Wonderland, where reality does not follow the facts and the observable physical phenomena that you get when you open your eyes and you open your ears. Truth doesn't govern that much. And that's a real problem because facts should matter, and yet they matter much less than you would think. I greatly admire scientists because scientists proceed on evidence and they develop hypotheses that are consistent with the evidence, and they go on to reach conclusions that are replicable by others who do the same experiments. Scientists really do honor facts, but people in the law, for some reason, have veered off into a world in which facts and truth don't matter as much as they should.
Let me throw an example at you also from my world. I've got a couple different examples that are outside of your book, but they're in the same spirit of where you've gone. I think I was probably, 19 to 21. I think I was below 21. Me and some buddies, we had a keg party, right? And I believe there was probably kind of an informal collecting of cash to help defray the cost or whatever. The police showed up with an undercover agent, a sting, and it ended up myself, I think others, we were charged with selling alcohol without a license. It spent 18 months in criminal court until it eventually got, basically, I think it got dismissed. But just the whole notion, I look back at it now after going through your work, and I'm thinking to myself, what in blazes were they doing? Wasting resources, wasting all that time to charge me with selling alcohol without a license. Clearly, that was not my intent. And that's what I wanted to bring up with you is the word intent.
Yes, well, what they have done is they have burnished their own arrest statistics. They've made it look like they have really been working for the public good. And arrest statistics, we live by statistics. It just made them look like they were more efficient, they were doing more, they were busting more criminals. It's basically a hoax on the tax-paying public who think that they're paying their police and their courts to protect them, when in fact it's a lot of make work. You know the concept of make work? It's make work for police and judges. If judges really were doing their job, they would berate police for bringing these kinds of cases into court. But no, they treat them as if they're real cases, and everybody plays the charade. And the defendant ends up having an enormous amount of expense, waste of time, and fright, because you're facing criminal charges, and it's no joke. The system doesn't punish this kind of official behavior, and it should. Frivolous prosecutors and police should be penalized for it. And instead, it's business as usual, and let's get the docket cleared up, and that's what happened to you.
Let me give another example too that I've seen. This one was in the news recently. Apparently, the best college baseball player currently in America, best player, when he was 15 years of age, sexually assaulted his 4-year-old niece. He pled guilty and went through whatever juvenile process there was. It was behind the scenes, but then it came out during his college career. So he's become a pariah. And if he did this, then rightfully so, he's a pariah. But the question becomes, people say, well, gosh, he's maintained his innocence and has said, hey, this was all part of the legal system. So the question I have for you as a defense attorney is, how could somebody possibly, this kid, and we're not trying to talk about the facts of this case, we don't know. He could very well be guilty. He might not be guilty. We don't know. But how could somebody like that possibly sign a document saying, I committed this crime when I did not commit the crime? Lay that out for people, how they can understand something like that could go down.
That is a procedure that is distressingly common in the legal system, both state and federal. You would think normal people, rational people would think, hey, no legal system worth its salt should allow that to happen. However, the Supreme Court, in a decision, the Alford, Alford decision, actually approved the process by which an innocent person who maintains his innocence can enter a formal plea of guilty in order to avoid a trial and in order to avoid the harsher penalty that would come from being convicted after a trial. Because traditionally, if you plead guilty and take responsibility and save the system the enormous time and expense of a jury trial, you're rewarded with a lower sentence. And in the Alford case, the Supreme Court, to its discredit, in my view, said that it's okay if a defendant pleads guilty and a judge accepts the guilty plea, even though the defendant maintains innocence. So what you have is the legal system is kind of traps for the unwary rather than a justice system. Justice doesn't have much to do with the system that we're describing.
Do you think that, you've been at this for 50 plus years, as you mentioned, you've mentioned Alan Dershowitz, he's been at this for many decades as well. Do you think that there is an army of young attorneys that share your passion for liberty? Are they coming up through the pipeline to, at some point in time, we all leave the planet unless they get the life extension stuff figured out. But do you think that is there a new round of people that are coming along? It seems like some of the old salty guys like yourself are the ones that have got all the wisdom, and I just worry that where's the next guys in line? Are they coming?
Well, I don't have right now too much faith in the college campuses and the people who are coming through the old meat grinder of the educational system. I think we're in an era right now where people who look at the legal system in an objective way and who worry about what we call rule of law rather than rule of the passion of the moment, I think those people are in a quite small minority. I know they exist because I'm in touch with them. They're in touch with me. They're in touch with Alan Dershowitz and people who agree with us. But you even have members of law faculties now who have joined the hunt, who have joined the mob. That is very disturbing. The colleges are in real trouble now because of the reign of the politically correct administrator. So, we're battling. I'm a co-founder and a current board member of the Foundation for Individual Rights in Education, headquartered in Philadelphia. We're fighting constant battles on behalf of innocent students at school who are charged with the most ridiculous offenses where the evidence is completely missing. And these students are threatened with being having a black mark on their name for life. They're threatened with being thrown out of school, even though no rational human being would possibly convict them on the basis of the evidence presented. So we have to fight for the conquest of truth and justice and fairness in an academic setting. You would think that the colleges would know better, that the colleges wouldn't be acting, like some a two-bit, sheriff in River City, that they would be rational, that evidence would be important. The colleges are in trouble now, and that means the country's in trouble. And we have to hope that enough students sort of see through the fog of what college administrators have inflicted on us and on them, that they come out into the world as young citizens fighting for the conquest of truth over falsity and reality over unreality.
Harvey, I've been watching in earnest Alan Dershowitz appearances on whether it's Fox or CNN coming on to talk about the law in the case of Trump. And one of the people, especially on CNN, that he usually is pitted against, I think is one of his former students, Jeff Toobin. So, the guys come on TV And Alan has this very just legal perspective. I feel like as a non-legal student, I feel like, my gosh, I get to learn from this guy. He's teaching me something, right? But I do feel like when I watch Toobin, I feel a little bit more of the political angle coming. Now, of course, Jeffrey Toobin is a very smart attorney. So what my question to you really is, though, is that once these guys leave the set and they get behind the scenes, is this all a game that's appearing on TV, or really a lot of the attorneys are very far away from you and Alan? They're in a different zone.
I actually have asked myself many times if Jeffrey Toobin actually believes what he says. And the reason I say that is, he was a student of Alan Dershowitz. He had you say, he's a practicing lawyer. Jeffrey Toobin has not been a practicing lawyer. He was out in the real world of law practice for a very brief time after he graduated. He then was given the perch that he has now, the media perch, CNN and the New Yorker, and he has this wonderful perch. And instead of illuminating the realities of the criminal justice system, he has kind of joined the wolf pack. His criticism of Alan Dershowitz makes me laugh, except when I realize how tragic it is that Toobin has jumped into the side of the wolf pack and is criticizing his former professor, when Toobin, in his heart of hearts, or in the deep recesses of his legal brain, has to understand that Alan Dershowitz is absolutely right, that what is being talked about, the Trump White House, about their crimes, these are not crimes. The president has the power to do what he's been doing. They're not crimes. There may be political problems. A lot of people will have political problems with what Trump is doing. They're not crimes. The solution is either impeach him, and by the way, you can be impeached, you don't have to commit a crime to be impeached. An impeachable offense is not the same as a crime.
Political process.
It's a political process, and the courts don't have any review of it. If Trump were impeached, he couldn't go to the Supreme Court to say, would you reverse the impeachment? The Supreme Court would say, that's political, not legal. We have no role in it. And that's true. Either that, or what the country could be doing, what the opposition to Trump could be doing is, God forbid, they actually get down to brass tacks and prepare for the next election and beat the guy if he runs again. That's the way the system envisions dealing with presidents who do things that a majority of the voters consider to be bizarre, bad for the country, terrible policy, but not crimes. These are not crimes. So Toobin has gotten completely caught up in what I call the wolf pack that's been pursuing Trump. And he should know better. And, Dershowitz is astonished by the vitriol that Toobin has been throwing his way, lecturing this professor who's got more experience, by the way, in the legal system in his left pinky than Toobin has had in his entire life. And he's lecturing Dershowitz. It would be laughable if it wasn't so sad and outrageous.
It is. It's a really strange time. As we dig into this topic, though, one thing I've kind of, for 30 minutes, I haven't taken you there, though, is the title of your book, 3 Felonies a Day. People might be wondering where that comes from, but we are talking about all these big players out there. We're talking about the president. We're talking about my crazy examples, a baseball player. But 3 felonies a day, that applies to you, Mr. John Q. Public out there. You are currently committing 3 felonies a day the way the system is set up. Isn't that true?
Yes. Of course, the title could have been 3 arguable felonies a day, because I don't believe they're felonies, but the law is so crazy that, especially the federal system, the law is so crazy that if a prosecutor wants to get you, if you're targeted, then they look at your daily activities and they can find felonies, federal felonies, arguable federal felonies, or even clear federal felonies that you've committed based upon a criminal justice system that criminalizes quite ordinary activity. making all of us vulnerable to federal prosecutors who are looking into our daily lives. That's the reason that Robert Mueller it's so easy for him to find targets and so easy for him to find people who would turn state's evidence and testify against the Trump administration, because, of course, everybody's committed felonies. The fault is in the legal system, not in the morality or ethics of the people being investigated.
Harvey, I'd love for you to go into another particular area, which a lot of people probably don't think about in terms of law. So, usually it's the legislators, whether it's congressmen or local town council members, state parliaments, they're making the laws, they're passing the laws. But the reality is Congress has passed the buck, local governments have passed the buck, often to regulatory law or administrative law, where essentially perhaps somebody that just even works in the local zoning office is literally typing up a document out of thin air with no legal justification, and you, the citizen, have to abide by it. And if you don't abide by it, I know, because I've been down the path, if you don't abide by some type of administrative law that doesn't exist in the code, if you don't abide by it, your only recourse is to sue. That's the only recourse.
This is a trend that makes the 3 felonies a day argument even more dangerous, and here's why. Federal administrative agencies have tremendous enforcement powers, but they have one type of power that is even more dangerous than their vast enforcement powers, and that is they have the power to adopt and promulgate regulations under federal criminal statutes. So the federal criminal statute is very general and broad, and it assigns to some administrative agency, the Federal Communications Commission, the Federal Trade Commission, any number of federal agencies, assigns them the power to enact regulations under the broad mandate of the congressional statute. If you think that it's difficult to know the federal criminal code so that you can conform your conduct to these broad, vague admonitions and prohibitions in the federal statutes, you ain't seen nothing until you've looked at the literally hundreds of thousands of regulations, violation of each one of which is a federal felony. I can assure you there is nobody in the country who knows all of the regulations. That is to say, nobody in the country knows the full scope of what is a federal felony. In a system where the laws are so numerous and also so vague and also include in their ambit prohibitions against conduct that normal people would consider quite ordinary rather than felonious, in a system like that, the prosecutor is king, because the prosecutor can look at anybody's daily activities and see that at least 3 things he did that day happen to qualify, looked at through the eyes of a prosecutor, as federal felonies. That's where I got the title for my book, that the average American going about his or her daily activity commits at least 3 felonies a day and doesn't even know it. If that person comes within the sights of a federal prosecutor who wants to squeeze that person in order to say what the prosecutor wants to hear, if you come within the sights of a Robert Mueller, for example, then you're toast, because of course you've committed arguable felonies. There's none of us who can pass the test of pure cleanliness in a system where everything is a felony.
Let me ask you a question about prosecutors, and I want you to start to kind of probe your memory banks. You don't have to give me a name, but I want you to start to think about the activity of an individual that you might have come across in your 5 decades. But I want to read something really quick that was talking about you and talking about overreaching prosecutors targeting anyone, anytime. And people don't necessarily think about the motivations of prosecutors. They may just think you're guilty. They may want to put some leverage on you to force cooperation. They may just be vengeful. I mean, people don't think about prosecutors could just be vengeful actors. They could just be building their own careers. So many motivations. Do you have anything that comes to mind in your career of witnessing a prosecutor up close and personal, your experience? Again, you don't have to name a name. If you want to, you can. But somebody that really just caused you to say, my God, how did this person ever get the power? And can you tell us, if you recall quickly, maybe what you saw them do that was just so over the top? And it would have to be somebody in your position to kind of be in the system to see how the legal sausage is made, to witness this firsthand.
Let's take the example of Robert Mueller. It's an example that we currently are following his every step. I've had experience with Robert Mueller. He happened to be the U.S. attorney and also a line prosecutor here in Boston at some point in his career. I actually had experiences with him. When he went to Washington, he was head of the criminal division. I actually had a meeting with him in Washington at my request. Alan Dershowitz and I and two other lawyers representing Dr. Jeffrey McDonald, who was convicted.
I remember the case. Yep, famous case. The
so-called fatal vision murder case. We represented McDonald for a number of years, and we had accumulated a tremendous amount of evidence that he was wrongly convicted, that the evidence presented at his trial was concocted by a combination of federal prosecutors, FBI agents, and Army military criminal investigation thugs. We asked for a meeting with Mueller, and he knew us. He said, sure, come on down. So we flew down to Washington, walked into the main justice building, and we walk into the meeting room, and they were sitting around the table are FBI agents. Mueller had not yet arrived, so Dershowitz and I and the two other lawyers on our team sat down, waited for Mueller to show up. Mueller walks in the room. He walks up to the head of the table. He stands up. He looks at everybody, and he says, welcome, gentlemen. I just want to start this meeting by saying that criticism of the Bureau is a non-starter. In other words, if what you're here to tell me is FBI agents did something wrong, forget about it. And of course, our whole argument for McDonald's innocence was that the evidence was concocted by FBI agents. We had flown down for nothing. He was not going to pay any attention because he was a true believer in the Bureau. He believed that the Bureau was a pristine, brilliant investigative agency. He was not going to entertain any criticism of the Bureau, any argument that they had framed an innocent man. The meeting was a ridiculous waste of time and money. That's the mentality. And I can tell you that different prosecutors have different motivations for this kind of conduct, that they're perfectly comfortable prosecuting people who have not committed crimes. Some of them do it. Mueller, he's a true believer. Others, prosecutors who were there for only a few years, who were looking to get notches on their hunting belt, so that when they are done with government services, they call it, they are hired by these white shoe law firms, Wall Street type law firms, which they're starting out with several $100,000 a year starting salary. And on their curriculum vitae on the firm's website is, he had 7 years experience as a career, as a white collar prosecutor, and now he's fully capable of doing white collar defense. You should hire our law firm. And these people have built careers on the graves of people whose lives, who they've buried through unjust prosecutions. The system that's a corrupt system that I just described. And yet that's how business is done in big law.
It's frightening. I've had so many smaller experiences in my life that truly changed me, because the moment one sees personally the law being used against you for political reasons, when you taste that and you feel that, it literally changes your DNA in an instant.
Well, there's nothing like being victimized by the system to radicalize you. A lot of the clients I've represented, a lot of the people whom I interviewed for my book, 3 Felonies a Day, they have been radicalized against the system because they've seen very close, uncomfortably close. They have been victimized. Many of them have spent time in prison, even though they have not committed what any normal human being would consider a crime. They have turned against the system, but there are not enough of them. And my hope is that people will wake up and realize that the Mullers of the world, you can't just accord them belief because they've been Boy Scouts all their lives.
You're doing the fine work, in my humble opinion, and I feel honored to get a chance to just share some time with you and learn some. So I really appreciate you coming on, Harvey. And in the future, if you want to even have a longer conversation, I'd love to take you down the path, because I know you've got so many interesting experiences. And I really do think you're right that if we don't talk about this subject, if we don't embrace it, if we don't try to get past this tribal political nonsense, I mean, it's really about, when I hear you talk, when I hear Alan Dershowitz talk, I don't know how sane people, whether they're on the right or the left, if they hear you talk, if they hear Alan talk, that's what I think Americans used to say, those are the guys I want to learn from. That's what I want to know. I don't want to be all in this other kind of like crazy state that we're in, this psychotic state, as you say.
We are in a time of troubles right now, and it is the obligation of every citizen to try to rise above it and to continue to speak, as the saying goes, truth to power. And if 95% of the law professors in the country have caught this disease, we have to be able to say, yep, 95% are crazy and only 5% are sane in this particular era. It's not a question of how many law professors think the president is guilty of felonies. It's a question of whether they're thinking straight or whether they're just caught up in a political wolf pack. And as again, I say, I don't like the president. I don't like what he's doing. This has nothing to do with my analysis as to whether he's committed crimes or not.
Harvey, I appreciate you coming on. Really great stuff. 3 Felonies a Day. Everybody should check it out. Anything they can find on you. If you're interested in the law, I mean, it's a great path to go down. You've really got fantastic insights. I appreciate you taking a little bit of time today to educate my audience.
I appreciate your interest and your audience's attention to what I've had to say.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, Trend Following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.